Okay, here we go. Module 3. So this this chapter basically takes you through a more realistic way of doing accounting. Because the thing is, right, businesses don't run on cash, at least not legitimate businesses, right? And normal businesses have this problem, as I was saying in the introduction, of the question of timing, of the difference between when cash flows around and when transactions occur versus when the actual operations of the business that are associated with these transactions occur. Right. So that's what this chapter's about, and the vocab word that's involved with that is accrual. So the first thing we need to do is just sort of some conceptual background here. We want to talk about what accrual accounting is about, including talking about matching the revenue and expenses to the times in which they are actually occurring. So when we're talking about accrual accounting, what that means is that we have to record revenue on our income statement when it's earned. And then we have to match the expenses that are occurring against the revenue with which they are associated. So the thing is that revenue is recognized when you provide the service, even though the cash is going to be received later. So what that means, think about it. If you're like a construction company and you decide to do a job to renovate a bathroom, and so your customer signs the contract, they give you a 30% deposit, and then you do the work, and they give you another 30% right then, and then you bill them for the remaining 40%. When do you recognize the revenue? You recognize the revenue when you actually do those construction services. And likewise, if you're renovating that bathroom and you buy a bunch of supplies that you're going to use for the renovation, you don't expense those. You don't put those on your income statement as an expense until you've actually done the job. Right? So you buy a whole bunch of tiles and tile goop that goes underneath them and paint and whatnot, and you buy those, but you don't do the job until the following month. You don't recognize those expenses until the following month. And so that makes sense from a sort of a conceptual standpoint, right? You have to do that, but the procedures for adjusting how you record these transactions becomes, the basis for this chapter. And so there's a couple of sort of vocabulary words, if you will, or ideas. This idea of recognizing revenue when it is incurred, just like I said a minute ago, or when a product has been delivered to a customer. And then you have to recognize the expenses in the same period as the related revenues that they generate. Right? So this is what the matching concept is all about. Now, here we go. We are going to do some more transaction analysis like we did in the last chapter, but we're going to look at some examples of these kinds of transactions. Okay, so this is that same setup as our prior example from the previous chapter. So if you remember, our story was that somebody was starting up a doctor's office. Okay, and so this is where we started here. We had balances of $33.20 in retained earnings. She invested $6,000 in common stock. She took out a $10,000 loan. She bought some land. And then at the end of that first series of transactions that we did in the prior chapter, she had $7,320 of cash on hand. Okay, so the next thing that happened was she received, or the company received $1,800 from ILS Company as rent for the use of Family Healthcare's land as a temporary parking lot from November through March. Okay, so they got $1,800 for 1, 2, 3, 4, 5 months usage of the land. But they got this money at the beginning of November. Right, so they got $1,800 in cash, right? But they haven't earned that revenue yet. This has to go into a liability category called unearned revenue. They got this money and they owe $1,800 worth of value in rent to ILS company. Okay, so it's an unearned revenue. It's a liability. They owe that. Okay, so it was recorded as assets equal liabilities and equity, right? And our balance is balance. And we had an operating cash flow of $1,800. And then over here on the balance sheet, we just recorded that as a liability. Okay? Now, the next thing that happened, they paid $2,400 for a 2-year general business policy. Okay, so they haven't expensed this insurance expense yet because they haven't used it up yet. They created an asset called prepaid insurance. Cash decreased by $2,400. The balance sheet is still in balance, right? So our assets balance each other out. We traded one asset cash for another called prepaid insurance, and now, we're going to have to write that down. So the next thing, they paid $6,000 for 6 months worth of malpractice insurance. So again, cash was decreased and the asset of prepaid insurance went up even higher. Right? They spent a lot of money on insurance and they haven't used any of it yet. She probably felt like she was running a little bit low on cash. And so she put more money into the business. Right? She put $5,000 more in cash in and recognized that as additional common stock or owner's investment. And then they bought some supplies on account. Now what that means is, right, if you buy something on account, that means you haven't paid for it yet. So she had good credit somewhere and she went over to her local hardware store or whatever and said, hey, I want to buy $240 worth of stuff, put it on my tab. Right, so at this point now she has an asset, she's got supplies, and she has an offsetting liability. She took on $240 in a liability account called accounts payable. And then the next thing is a little bit complicated. They bought $8,500 worth of equipment. They paid $1,700 down, and they are going to pay the rest off in 5 installments of $1,360, which adds up to $6,800. So then they took on another liability here. There's our cash down payment. Right? We have an asset value of $8,500, and the remaining balance due goes in as a notes payable of $6,800. And then the last transaction that we're just going to look at real quickly here is that they provided services, medical services of $6,100 on account. That means that their patients haven't paid them yet. So they now have an asset called accounts receivable, right? No cash is involved, but over here in retained earnings, because that was a revenue transaction, even though they haven't gotten the cash yet, the retained earnings goes up, and down here in the income statement you see that you're recognizing the revenue even though you haven't gotten the cash yet. And then of course they also were providing services for cash patients, and so they did earn cash for some of their services, and that also shows up over in the retained earnings and in the income statement as well. And then they paid $100 of that bill that they had for $240 of the supplies. Right, so they paid $100 on that bill. Their supplies accounts payable went down by $100, and they're left with $140 at the end of the day on their accounts payable. And then here we have a whole bunch of other expenses, wages, etc., just like in the last chapter. Those added up to $4,690, which shows up on the cash flow as an operating cash flow and reduces retained earnings. And then finally, at the end of the month, she paid herself. She paid herself $1,200 in dividends. If this were a sole proprietorship, it would have been an owner's withdrawal. But she paid those out of retained earnings. And that gets us through the end of the month. And so we're going to talk about like sort of processing all of this stuff in the next lecture. Okay, so that was just a bunch of sort of recording transactions. You know, how do you take into account each of these things that occurs, right? What you probably should do is watch this video over again and stop the playback after every transaction to see if you understand what all these things actually were and represented. And then we will move on to what to do with all of this, okay, next.